With the help of economic theory, we can extract messages from the growth of demand supply about the pressure of demand and thereby infer the level of economic activity in the economy. It is important, of course, to remember that movements in the monetary aggregates reflect both movements in the rate of inflation as well as in the level of economic activity, that is, both price and volume type fluctuations. The role of monetary aggregates as an economic indicator has long been the subject of intense debate. The velocity of circulation of money, as measuring the relationship between the stock of money in an economy and the level of economic activity, may change over time, thus making movements in the monetary aggregates difficult to interpret over the longer term. In most countries, monetary figures are timely and regular, and normally they're published on a monthly basis. There are usually also monthly type of figures on the amount of credit taken out by consumers, which can be taken as an indicator of consumer spending. Business survey data is another one. In many countries, the traditional type of economic statistics are complemented by surveys of business opinion. Such surveys are generally kind of frequent and may therefore provide a more up-to-date picture of economic activity than the official economic statistics relating to national output, which are reported after inevitable time lags. These surveys take a qualitative approach, asking the respondents to compare the state of business from one period to the next. The focus may be in terms of general kind of confidence about the economy outlook, or on items that are specifically kind of related to activities such as expectations about the levels of output and stocks or order books. In essence, such information provide predictions as to whether activity will increase or decrease relative to an earlier period. There are also some surveys of consumer confidence which can act as useful indicators of the future spending patterns by individuals or households. Next up is labor market statistics. Generally, the labor market statistics represent another pointer to the state of the economy. The information includes figures for unemployment and job vacancies each month, as well as estimates of the number of people employed in the whole of the economy. The release of such information is especially important in times of economic recovery, signaling perhaps a potential shortage of labor and the threat of inflationary type of pressure arising from higher wage demands. Such information can often lead to quite volatile movements in stock exchange. The significance of labor market statistics as an indicator of economic activity is diminished by the fact that they tend to react some months later than changes in output. This is because companies tend to wait for changes in output to become more firmly established before acting to take on more workers or to make existing workers redundant. Consequently, employment and unemployment, all the statistics that concern unemployment and employment are often described as lagging indicators of economic activity. What about the cyclical indicators? It should be clear to the reader that there is really no end to the range of information that may tell us something about the current and future states of the economy. Apart from those discussed already, there's a myriad of indicators for individual sectors of the economy, ranging from new construction orders and housing starts to the weekly sales figures of a single department store chain. In addition, there's always our own, what we call the gut instinct. And typically, there will be no consistent type of picture emerging from these various sources, especially at turning points such as the peak or the trough of the business cycle. The chances are that some series will be pointing upwards and other downwards. It requires a considerable amount of judgment to interpret and explain such diversity indicators. Generally, the government's statistical departments consolidate the information from a number of data series into several kind of distinct composite indicators of the state of the economic cycle, giving rise to a number of indices, what we call longer leading index, shorter leading index, the coincident index, and the lagging indices. The methodology behind such indices is often quite complex. The components are smooth and detrended and then amalgamated using sophisticated techniques of time series analysis. And while such type of series do not give any new information on the economy, they're useful means of combining the information from a number of individual series.